Hello again, everyone. We'll call the meeting to order at 3 o'clock. Any board communications to share? Finance director could not make it today. She did send out an update to everyone via email, and we'll post it with our minutes also. We'll move on to the approval of February 13th, 2025 meeting minutes. Okay. Moved by Alfinger, second by Pollard. Any discussion? All in favor, say aye.
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 Opposed? And that's an aye. Opposed, same sign. Okay. Unanimously approved. Thank you. Moving into number 4, authorization of payments from retirement fund for retirement benefits. We only have one today for Kim Allen.
We accept the authorization of payment for Kim Allen.
Second, Michael.
We have a motion by Pratt, second by Freeman for authorization of payment. Any discussion? Question?
I assume it's a 5-year vesting.
Yeah, 5 years. Yeah.
It used to be 10.
Depends on which you're in. There's difference between different groups. So, yeah. No other questions? All in favor, say aye.
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 Aye. Opposed, same sign. Motion carries unanimously. And,
Just
okay.
curiosity. You have to remember what.
You know, I was trying to look at it earlier too, and I couldn't remember either.
Yeah, no, I hear you. Yeah.
The name sounds really familiar.
No, that's fine.
I know. Yeah, I was just looking about that for the meeting. I looked through my emails to see if something popped that did. Okay, moving on to SCI. Pat?
I sent all the books. Does anyone have a copy I can just borrow one? I'd sit here.
Sure.
All right, so we'll get started. There's really not a whole lot to talk about since our last meeting. Obviously,
Nothing interesting.
there's a lot that's happened since the last meeting, so we'll go through some of that together. So page 2, you can just look at this. You can use it for your meeting minutes. I'll go through all these points. So we'll just move ahead to slide 4. So what we're looking at here is GDP growth for the fourth quarter of last year, and that was around 3.1%. So we had good, strong growth in the fourth quarter. Obviously, we had the election going on towards the end of the quarter. We did see international sell off pretty tremendously during that quarter because of the tariff threats that were happening. They weren't obviously weren't in place at that time, so we saw international sell off. But all in all, we had a strong quarter. The latest quarter, the data came down, GDP growth shrunk for the first time in a while. So 3 consecutive quarters of that, we're in a recession. So we'll have to keep a strong eye out for that. From a tariff perspective on page 5, I think this slide tells a lot of the story, right? So what you're looking at is here is a chart that goes all the way back to the Great Depression back in the 1930s, all the way to current, what the maximized proposed tariffs would be if they all hit. And as you know, today news came out, there might be, there's some sort of deal going on with the UK, so the market responded positively to that. But looking back, the tariffs will be higher than the Great Depression or close to the Great Depression levels. I don't know if any of you know, but what happened in 1939 after all these tariffs? World War II begun. So I'm not implying that's going to happen, but that's what happened. It's just a historical framework.
Now, UK, what are they, around 1/8 or so of our largest partners?
Yeah, they're in the top
Yeah,
10 for sure.
There's a surplus to them, right?
Well, there's balance. It's kind of a balance. If you look at gold and other things, it actually makes it a surplus. But yeah, it's more of a balance now. So you know, lots going on now. If you think about a tariff is a tax on a corporation that usually gets passed to the consumer. Sometimes companies will give some of the tariffs to the consumer and eat some of them because of whatever products they're selling, because it really could be detrimental if they raise prices too much. But the majority of it will end up coming out of our pockets and our wallets. So GDP growth hit, if the maximum proposed actually happens, could be anywhere from 2 to 2.7% in that range somewhere. I'm sure Mark will speak to it. He may have slightly different numbers. So that would pretty much wipe out the fourth quarter GDP that we have, if that all takes place. So there's a lot of what ifs going on here. I really think a lot of it's negotiating tools like you did the first go around. So we'll have to see how it plays out. But it's something we have to keep our eye on because it could be a tremendous impact to the economy and global economy as a whole. Page 6, interesting chart here. So I mentioned fourth quarter international really sold off because of the threat of tariffs. But if you look at this chart and we go into the first quarter of this year, the US sold off significantly. And international actually held up pretty well, and fixed income. So you would think, when you look at these markets up and down 1,000 points here and there, you're like, oh, portfolio, that's right. I can tell you my 401k is, but your pension plan is not. It hasn't experienced all this volatility because you're well diversified. Page 7, growth versus value. So every time I come out here, growth is winning because of back 7. Growth actually was down 10% for the quarter and value was up 2%. We had a couple factors going on. International doing well, value outperforming growth, and fixed income outperforming as well. So those components of your portfolio help hold it up during periods of volatility. Page 8, this is another way to look at it. All international and emerging markets was higher than the US. I'll let Mark speak to a little more on that side of things, so he has something to say. Page 9, looking at the yield curve, it has changed tremendously, right? So we came from that big inversion we talked about last meeting. Now we have kind of a steepening of the yield curve, but also the yield curve coming down as a whole. So that, when the yields come down, prices go up. So that's why fixed income during that
Glad my portfolio
It's conservative.
The Fed met yesterday. Again, they're very data dependent. Trump's really pushing for rate cuts. Powell's kind of holding firm because he's very data dependent. It's not in the data yet. So he can't do what he can't see. So I would expect as we move forward a few quarters, you'll hear more about that and the potential for maybe rate cuts as we move forward. We're not expecting a lot of rate cuts this year. Really all depends on the tariffs. Okay, so we'll get right into the performance. Okay, so this is just your fiscal year view here. So you can see you're at a 5.41%, net of fees 5.25, and we outpace the index net of fees. That's always a good positive thing. So decent fiscal year coming to an end very quickly, right? And then if you look at where the returns came from, so if you look at the 3 months, you can see large caps were down minus 4.52%. That took the biggest hit. We put you in US equity factor base, which is more defensive in nature, more value driven. That actually outpaced the S&P 500 and the Russell 1000. Pretty much every US index you look at, that was only down 2.7. That was very beneficial to the portfolio. International, well, you see small caps took the biggest hit, almost down 9% of the Vanguard small cap equity index. But international fared well. So your international as a whole was up 7.2. That's why your returns were there. And then secondarily, from a fixed income perspective on page 14, and a couple things we can look at here. So if you look at the 3-month return again for the quarter, core fixed income was up 2.91%. That outpaced the limited duration, which is a new portion of your portfolio. We diversified across the yield curve. We shortened duration of the portfolio. But when you look at it from the 1-year standpoint, that move actually outpaced. It was up 6.13 versus 5.36. So since we put that in, it's outpaced. That was another good move so far in the portfolio. And frankly, it's really good to be diversified across the yield curve because of everything that's going on. That's very positive. I mean, you can see real estate had a really good fiscal year. That bounced back. This is mainly REITs. That was up pretty considerably, double digits there. That definitely had. So all in all, not too bad. The next pages are just kind of giving you a year-to-date calendar year view, so you can look through that at your leisure. You can see, looking at a year-to-date basis, you're still positive, we had all that. Slightly positive. all I had, unless there are any questions.
Any questions? Okay, thank you. Mark? Move on to you.
Right. Nice and concise, Pat. It's hard to argue with Pat. He and I kind of did a pre-call, and I think we're on the same page with most of the observations about the economy and about the portfolio. I'll just reference, I'm gonna share another screen. Sorry about that. I'll share your version with different pagination there. Okay, bear with me 1 minute. I think as I've been meeting with plan sponsors and clients, the disconnect between where the markets actually are and what happened in the first quarter, it's been kind of big. I think a lot of our clients have been expecting larger losses based on headline news and the amount of volatility we've had in the portfolio. So to see the portfolio actually have a slight gain is impressive and speaks to the diversification. So two major themes, and Pat kind of hit them, is extreme volatility, losses of 6 and 7% in US equities in 1 day. And then on the day that Trump gave the 90-day extension, we saw US indices up 10%. So trying to time this market in any way is a fool's errand. I think the other thing that sticks out is as you look at 331, a lot of that data, it's past looking, and it actually tells a decent story. If you were to flip through our two presentations, you'd be like, yeah, the economy is in pretty good shape, but there's so much uncertainty around the tariffs to kind of predict where the next couple of quarters is going to go is difficult. Pat alluded to the negative first quarter growth. That looks like it's going to be, somewhere around a 30 basis points contraction. It's probably inevitable that no matter what happens with tariffs, there has been some damage done, right? There's already 30% less containers coming over from China. So even if we get back online pretty quick, there'll be some disruptions. So most likely when we meet next, we'll be talking about we'll probably be in at least a mild recession, depending on kind of some of the outcomes of tariff negotiations. So yeah, I think my deck tells a similar story. Basically the exact opposite of last time we met. Last time we met, the only positive index, the major market indices, was the S&P 500. This quarter, if you look at the bottom of this page, it's the only negative asset class. And that's, again, why we diversify the portfolio. I think some of the moves SEI made with the international, the emerging market bonds and the factor fund, really added some additional alpha to the portfolio. So very different scenario there. This is our economic scoreboard. So this is really point in time and almost impossible to play out forward. We have a lot of clients kind of asking us, some of our corporate clients, kind of how do you see this? How will this look at the end of the second quarter? And I think that the only answer is I think a lot of these will be diminished at least, right? So I think from a positive standpoint, looking back on growth in 2024, it was a little bit above average. Corporate earnings were strong. Inflation was moving in the right direction. From a neutral standpoint, we were watching the Fed. The Fed has no choice. They're in a tough spot. They're getting pressure from the administration to lower interest rates because that kind of is on the agenda. But they're being very cautious not to add to potential inflation. Worst case, if we go back to kind of Liberation Day numbers, when we're looking at the tariffs, that could be very inflationary. And if the Fed were to cut interest rates, that would just add to those inflation pressures. So unfortunately, they're going to wait, and they probably aren't going to do anything until they see a deterioration in the employment market. And we actually got pretty good numbers last Friday, but again, looking back at April, a lot of the federal cuts haven't kind of filtered into the unemployment report yet because they're still being paid. But as the year progresses, that's going to have a hit to that unemployment number. So we're not expecting much help from the Fed. They'll meet again in June, and I don't know what the percentage is. There's actually kind of betting and odds. I think there's a decent odds. I think more than 50% that they might cut interest rates 0.25% in June. But depending on where we are with trade negotiations, they may sit on their hands again next quarter. For sure, what we're going to have is a negative is global trade. At least at some point maybe that'll move neutral. Fiscal spending, while it can help GDP in the short term, government spending can help GDP. It adds to the national debt, which is not a good thing for longer term growth. And housing's been kind of a drag on the economy for a while due to inventory. So touch upon this a little bit more. I kind of like this slide, just again, the diversification, because we've had committees been, kind of questioning. Some of my clients I work with on endowments, they're kind of questioning why we had international exposure and why weren't we overweight US stocks. And, if you look at this slide, it shows 3 time periods. The green is the first quarter, the gray is 1 year, and the blue is 3-year numbers. So see those losses, the 5 to the left for the quarter, those are all US indices, small cap US stocks getting hit the hardest, the NASDAQ, those tech heavy indices, the S&P down 4%. And those have been the dominant indices over the 1 year, 3 year, 5 year, 10 year. But all of a sudden we're seeing a revitalization in international stocks. So, up quite a bit, emerging markets up about 3, the world minus the US up about 5, and then developed international up about 7%. So while we haven't seen it in a while, international is not only outperforming, but outperforming by about 14-15% year to date. So kind of interesting to see. We don't really naturally think that's going to continue on a multi-quarter run, but it's been kind of refreshing to see that diversification. Pat talked a little bit about the yield curve. We don't know. Rates have been pretty volatile. Again, within the portfolio, because we're so diversified, it's immunized. But looking at individual holdings, it's been interesting to see bond funds, might change 60 or 70 basis points up or down in a given day. That's not bond-like type of performance, almost equity-like performance. So there's been a lot of volatility. We think at some point, once we get tariffs settled and at least know the rules of the game, hopefully we'll see the Fed bring interest rates down a little bit. They've got that kind of ammunition if they need to. If we do slide into a recession, cutting rates can be stimulative. So they still have those errors in their quiver. So kind of very similar outlook. A lot of uncertainty. You can kind of play out a couple scenarios, good, bad, and maybe okay. And it looks like today could be a decent step with the UK agreements. Pat covered the assets. Again, our role as kind of an independent advisor is to look at the underlying funds in the portfolio. We look at 9 criteria. Performance is the largest, if you see the black shaded. We look at the 1, 3, 5, and 10, of course. Weighting the 3 and 5 most importantly. We look at risk-adjusted performance, and we want a consistent ride. We don't want a fund that outperforms 1 year, then drastically underperforms the next year. So we're looking for consistency. That's the rolling 12-month returns, and then batting average. We look at funds. How did they hold up in a down market like we've seen so far this year? How much of the gains do they get in an up year, in an up capture? And of course, expenses play a role in all that. We are in a great spot. The funds all pass our scoring, the underlying funds. They're on average in the 20th percentile. So basically what that means is the SEI funds used in the plan, on average, are beating 80% of their peers. So that's very good. We as a mandate, we're kind of looking, we want to be in the top or second quartile. What this slide shows you here is the 9 criteria that I showed you and the ranking of each fund. I'm just going to blow this up a little bit. Shrink it so you can see. So again, the 9 criteria that I showed you in the pie chart, how each fund scores versus its peers, and then the overall score to the far right. Again, lower is better. So if we were to look at the SEI limited duration fund, we're comparing that to all similar intermediate bond funds. We're ranking it versus their peer groups. And you can see the scores across the board. This is showing that this fund is beating about 2/3 of the funds in its peer group. Emerging market debts we've talked about before, a little bit of a unique way that SEI manages the portfolio. Is a very small peer group, so good quarter, bad quarter can change the rankings. We've been very happy with the performance this fund has played and the diversification this fund has paid within the portfolio since we added it about 3 or 4 years ago. We have several index funds in the plan. They are very low cost and they all pass our scoring, so no concerns there. You can kind of see the historical rating. The SEI emerging markets debt, the way we look at it versus a broader peer group, it's scored top or second or third quartile. Really have no concerns with it. When we look at its benchmark that SEI manages to, kind of a dual benchmark, the fund has performed very well. So because it had hit our third quartile score a couple quarters ago, we have it on a watch list. Looks like it's trending to a place where we'll take that off our watch list the next time we meet. It's a pretty small holding within the plan. That's my talking points. Kind of short and sweet as well. The plan's in very good shape. It's well diversified. That has kind of shown through, kind of living proof based on that really volatile quarter to come out with a positive return for the first quarter was pretty impressive.
Questions for Mark?
It's really just a question for all of us. I mean, I get that, the reports are pretty positive, and 1 month, 3 months don't make a trend, but the trend is going direction. And the only time you really lose money is when you start taking money out, losing that opportunity in the future. But is there anything we should be doing? I mean, to me, this is like watching a slow train wreck. And I'm certainly not an expert at all, and I'm usually very, very, very conservative. But I think we've dodged. The economy's dodged a few bullets, and the fact that you're not talking politics at all, or that's not my intent, but the fact that you break something to then come around and say we're going to repair it incrementally, it's still broken at the end of the day. And so I guess, be it now or for the next meeting, is there anything we should be doing to better position ourselves with respect to minimizing losses? I get it, fiscal year to date, we're up 5.41% total portfolio. But in fact, for the last 3 months, we're at 5.56, but for the last month, it's been a negative number. So I just think a lot of us are kind of like, it hasn't been as bad as we thought it was going to be. But great, we're going to sign an agreement with England, and we're going to sign an agreement with somebody. But at the end of the day, and I think both of you have kind of made reference to it, there is going to be long-term damage done. So it's really a question, should we be looking at it? Maybe not today.
Yeah. So I'll answer that in a couple of different ways. One, we're managing the managers, and the managers within your portfolio are trading every day, taking advantage of opportunities. That's number one. There's changes happening as we speak. Secondarily, you're very well diversified. And like we mentioned, fixed income, international, those legs which haven't been helping out are finally helping out. Timing the market, that's the third thing I'll answer. So let's go back to the credit crisis back in 07, 08, early 09. If you got out of the market in 08 and you didn't get back to the end of 09, you would have missed out on 40, 50% returns. The key in this game is to set asset allocation, which is the most important decision as fiduciaries that you'll make. The second key is be well diversified. And once you have that, it's ride the storm out. Because once you make that decision to sell, go to cash, or put a significant portion of your portfolio to go into cash, 2 months later, if the markets start going up, it goes up tremendously from a big downturn. So you have to be really careful of that. So I think you're in a really good place. We've been positioning leading up to this. We shortened duration because we knew eventually things were going to happen in fixed income. We knew those Mag 7 stocks in the S&P 500 were way too risky, way overvalued. That's why we brought in, we worked with Sageview and we brought in U.S. equity factor base. So while we're moving some into equities, it's a much less risky portion of the equity market. Markets that haven't performed over the 5, 8 years, where these high tech giants really have now. That's Mark might have some words to say.
Mark, anything to add?
Yeah, I just agree with that. I'd look at recent history, common emotions when markets get this volatile. You might say, why would we just get, cash is still paying 4.25? Could we just take the 4.25 with no risk? I mentioned the day, the day Trump, so let's say we sold out the day before Trump initiated the 90-day extension, right? The markets rallied, the US markets rallied about 10% in that one day. If we were on the sidelines, we have 57 million or so in US stocks. I mean, that would have been a $5.7 million hit that we missed out on in just that one day. So it's the two trades that Pat mentioned. Getting out sometimes is easy, right? I want to get out and not deal with this. I'll just take the 4% cash rate. But when markets rebound, they rebound strong, and it's almost impossible to get back in. And the amount you give up on the upswing almost never outweighs what you've avoided in kind of the choppy terms. Because this money and because this is invested for a very long period of time. Unfortunately, you have to ride out these periods, but the portfolio is so diversified that there should be always something making money when other sectors are losing money. So the goal is to have a smoother ride, but we can't immunize it against short-term losses. That's kind of inevitable in investing.
Michael?
I had the great displeasure of sitting on the state pension board when the Great Recession hit. And I'm just trying to figure out from everything that was just stated, most of which I agree with, how well positioned are we for what I see as an imminent recession about to begin in the next 3 months or so? So I guess it's kind of what Mark was saying. Are we well positioned to take a hit, as it were, knowing there's an upside as long as we don't do anything foolish and jump out if a recession were to hit? Or are you not able to tell until you get into that bailiwick?
I think you're very well positioned. Obviously, if we have a recession, there's going to be, we already had drawdowns in certain markets of 10%. And if you look at the NASDAQ, there was actually a 20% drawdown. So the tech sectors hit a bear market, which is 20% or more in sell-offs at one period of time. It's obviously bounced back a little bit from there. But we have you in a very good position. You're going to have losses if we do hit a recession. But the question again is, typically when there's a recession, if it's a mild recession, it's not going to last that long. Typically when there's a recession, the markets pick up. I'll use this as an example. Halfway through the recession, they start going back up. So there's no foolproof inflation unless we go like 100% gold and we go under inflation. That might be your only shot at a foolproof. But again, we've seen gold spike up huge nowadays. In the last couple of days, it's sold off pretty significant. So again, diversification is key. We think you're well positioned. We hope there's not a recession. There's a more and more chance there'll be a recession. But we think you're in a good place right now to ride through that with the changes we've already made. We've been building up to this. We knew that a lot of this was coming, especially if Trump was elected. We knew tariffs are going to be on the way. So it's been a slow build to this portfolio over time.
Okay, thank you.
Hey, Mark, you're on mute.
Oh, sorry. Usually if we have a recession, this is a little bit different because we're also fighting maybe a higher inflation with type of recession. That would be a dangerous spot. But normally in a recession, growth slows, the Fed cuts rates. We've got, I think, about 42% in bonds. you're going to see a rally in those bonds. So again, that diversification at play. You know, the risk from a recession is usually on the equity side, and then we're well positioned with other asset classes that should rise. So it doesn't mean everything goes down. Usually it's equities. It's usually an equity sell-off during a recession, but oftentimes before you're out of the recession, the market, because it's forward-looking, is already rallying. So the market is looking ahead. The recession is kind of looking behind, right? Prior 2 quarters, slower growth. And again, timing that is difficult. And I just agree with past comments about being very well diversified and having to write it out. If we were to say to try to time it, I can almost assure you, if we said, Pat, try to time this and navigate around it. Not that he's, you know, SEI doesn't have some really smart people, but they probably not going to get it perfectly right. It's because the market's oftentimes very random.
You know, you
Thank
think
you.
of, I'm assuming you're saying the Great Recession is the credit crisis that we had back in 07, 08.
Right.
That was a very different time because credit was breaking down. So fixed income was selling off significantly and equities were selling off. So that was a period where you really had no safe haven at that point in time. I mean, banks were going bankrupt, going into default. So that was a serious situation. I think our banks are in a much better position now, obviously, than they were back then. So I'm not too concerned about that. You know, we don't have a lot of credit in your portfolio, you know, especially limited duration, but you're in a good position. We diversify across the yield curve. We de-risked your equities. So we've been building up to this. I feel pretty comfortable. It's not to say we're not going to have negative returns. So next time media I come out, we're going to have some negative returns. So
Minimize, yeah.
we're going to minimize the negative returns. Exactly.
So, can I ask a question?
Sure.
So I think that you're saying that, you know, in a normal business cycle, right, this is a well-diversified portfolio works. Pat started the comments, you know, referring back to 1930 and all these, you know, things, and the nature of this situation where it's, you know, a self-inflicted wound with kind of a, you know, again, it's one man kind of making these decisions. It suggests that it's not a normal time, and it's the, you know, the normal business cycle trends and things may not apply in these circumstances, but nobody knows. So maybe another way to ask this question: what would the circumstances have to be for us to regret keeping the portfolio as it is? In other words, if we saw like obviously a 5-year collapse in equities would be a scenario in which we'd probably say, gee, we should have sold, or what, you know, what other surprises might there be that would make us regret? And I'm sure that there are some hedge funds or different scenarios and saying, all right, you know, my hypothesis is suggesting we get out of the normal portfolio. And I'm not advocating any of those, but I just think for the
It's a good question.
yeah, what would have to happen for us to regret staying the course?
If we hit the scenario you're talking about, we're all going to have a lot of regret. It's going to impact every single pension plan in the United States. It's going to impact every 401k, IRA.
So I had this vision. Not to interrupt your answering my question, but when we had the first few days after the Liberation Day, and we saw these declines, I was thinking that we were going to be having in this conversation today a discussion of how we start to restore some of the losses in the pension fund, and do we have to raise, you know, property taxes and other things, and you get sort of this downward spiral because you've got to pay people's pensions.
Right. So there's a couple things we're doing in the portfolio that adjust for this over time. Right. So we do quarterly rebalancing in the portfolio. So it's kind of a buy low, sell high mentality, right? Kind of dollar cost averaging. So let's say, you know, your US equities have been down significantly in the first quarter relative to international. So when we're doing our rebalancing at the end of the quarter, we're taking that international that's performed very well, and we're moving that into those stocks that have underperformed during that period. So that's kind of the first answer to your question. So that alone helps because you're moving money based upon who's winning and who's losing, right? It's a very smart way of investing. It's the way institutional investors typically think and work, right? So that's number one. And number two, like I mentioned, our managers are trading every day, with the exception of your index funds, because they're just going to be indexed. But the active management components in your portfolio, which I think is key now, I think active management going forward, especially in this environment, most likely will win. And we can talk in a year and a half, put that on your calendar, and we'll see if that's true or not. But them making trades within the portfolio, it's reacting to these markets, right? So if there's opportunity sets that are out there as a result of this, let's say small businesses really take a hit, there might be more flows into that area. Eventually, those companies will pick up. So the answer to your question is asset allocation is kind of the same answer I gave before. Asset allocation is key. Diversification.
No, I think the question though is like, what would the scenario be? And the scenario, I guess, would have to be a long-term collapse in equities. Is that right? That would make us regret this strategy.
Yeah, absolutely. That would make us regret the strategy. And yeah, anyone who's in a strong asset allocation portfolio, well diversification, if equities take a hit across the globe for a long period of time, that's going to be very detrimental. We're hoping that doesn't happen.
Right. And so if we believed there was going to be a long-term, 4 or 5 years collapse in equities, we'd move money out of that and into other things.
Yeah, right. I mean, we've talked about alternatives here before. Years ago, unfortunately, we weren't able to get them into the plan, but things like that helps diversification, right? So hedge funds might help reduce volatility over long periods of time. They're more expensive, they get locked up for longer periods of time. But those type of strategies definitely help out, especially if there's an extended period of where equities are underperforming. Some of these alternatives out there might actually benefit the plan during that period of time. So there is different levers. Me and Mark can certainly talk about some of these if you'd like us to. Again, we've tried it in the past and it just didn't really work out from an asset allocation.
I think your point to the individual manager, right? So they're looking out at macro level. So even our stock fund managers, they can immunize the portfolio a little bit by looking at more conservative stocks within the portfolio. The fixed income managers, they can look at the duration of the bonds they own. So within each component, there's different things the manager can do to minimize risk if the macro outlook does not look strong for the coming years. They can dial down individual pieces of it. And again, this is a pension plan. So it's driven by the actuary saying, hey, we need to meet the future needs and the payouts of participants. So that kind of drives the underlying asset allocation as well. But
Thank you.
yeah, I say saying all that, the portfolio can pivot. This committee can discuss it, and we could pivot if the long-term range outlook for equities becomes very low or negative. We tend to look at market cycles, and unfortunately, the day-to-day, with an administration that uses social media and drives markets intraday, sometimes it's harder to plan out.
Yeah, well, the good news is that Trump is sensitive to the stock market and the equity performance, right? And so if he had stuck to his guns more, then I think we probably would have found ourselves in a very, very different situation. But he responds when he sees the stock market go down. All of a sudden, he has a new strategy. Yeah. So that I think helps us, gives us confidence that our strategy is appropriate.
Yeah.
Thank you. Moving on to other business, interest rate on employee contributions. There's a policy that we follow setting the interest rate on employee return contributions, being those employees who terminate employment with the town and take their retirement contributions. For the policy, it will be set at 5.4%, applied as of June 30th, 2024. We do need to accept and file this information.
So moved.
May I ask a question? Is this if they take the total? You mean
Yeah,
they take the total?
Right.
They don't.
They get some interest back with it. Yes, they're no longer vested. They're out of the plan. Okay. Got a motion by Alfinger, did you? Second, I'll second. Second by Pratt. Any discussion? All in favor, say aye.
Aye.
Opposed, same sign. Motion carries. Do we have any other business? And if not, our next meeting date is August 14th. So we were at them. Thank you. Motion to adjourn?
So moved.
Who's the second? Alfinger, what, the motion, who seconded?
I'll second. Freeman.
Freeman, second. Okay, all in favor, say aye.
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 Opposed, same sign. We are adjourned at about 3:40. Thank you, everyone. See you soon.
Bye-bye.
Hi, Mike.
Positive thoughts.